So this week we are talking about um, liquidity management, asset management, liability management, capital adequacy management, and banks, for commercial banks per se. We did spend some time talking about how the liabilities for banks and the assets for banks are not as intuitive as it is for corporations, and deposits are the liabilities for banks, and they are sacred, and that the credits are the assets for banks. So I have on the screen, as you can see, Office of the Controller of the Currency, a definition of liquidity, which is the risk of a bank's earnings and capital arising from its inability to timely meet obligations. So most of the time when we talk about liquidity, people seem to think, how much cash a bank would have. So, on the screen, you can see I pulled up JP Morgan Chase balance sheet, and you can see the cash versus the total assets, and that's actually a significant amount of cash a bank, usually should not have, but Chase does. So I'm sure they have a good reason for it. But that's not exactly what we mean by liquidity of a bank. So I pulled up a spreadsheet, and we did discuss this in the past weeks just a little bit. But to give you a conceptual view of how liquidity works for a bank or what it really implies, I'm just going to make up a situation. Let's say that we actually have deposits, and I'm not going to bother with accounting, the left side, the right side, the assets, and all. Let's talk about deposit. Let's say that we actually have $1 million of deposits. Let's make him look all in US dollars. So, of these deposits, first of all, I have to keep some cash. Just as the Chase has it right here that they have some amount of cash. I need to actually keep some of this as cash. So obviously that is part of our liquidity because it's an obligation. If a customer comes along and they say they want to withdraw money, I need to have that in the branch, in the vault, in the account, and have that money available to pay the customers, the clients who are asking for their money. So let's say that I'm going to keep about, in the case of Chase, it's a little bit more than 20%, but let's just say that we're going to keep about 10%. So of this million, I'm going to keep about 10% in cash, so that's about $100. So above and beyond this, I also have to have set aside some reserves. So central bank requires me to set aside reserves for the deposits that I collect. And this amount can actually change. This is usually how the central banks create money or create liquidity in the market, by changing the reserves for banks to either expand or restrict the market a little bit. So let's just say that we have about a 15% reserve requirement, and that's off the overall amount. So $1 million deposits, and I have $100,000 cash that I need to set aside as my liquidity and or as my initial most obvious liquidity. And then I have to set aside about $150,000 for reserves. That sets us about 50%. So what I have now as a bank to play with, what I can actually lend out, right? So what is available to the bank? So, and that is your $1 million deposits that we collected, $100,000 cash that I have to set aside that I'm subtracting, and then $150,000 reserve that I'm subtracting. So I have about $750,000 cash from deposits that I can, that's available to me as a bank, and I can actually lend this out. Now, all this is good, because I'm not paying as much percentage interest on the deposits. Most of them are checking accounts and, very short-term time deposits. And, if I have any CDs and stuff, But with respect to the credits, I have longer term credits. Even a simple consumer loans, you're talking about a few months on a credit card. And for consumer loans, you're talking about 1 year, 2 years, car loans, 5 to 6, um, 7, I think. And then for RVs, 10, and then mortgages, 20, 30 years. You do see the difference of maturity mismatch. So initially, that's a problem. And that's actually part of our liquidity problem. The maturity mismatch of your deposits and of the money that you lend out, your assets and your liabilities and your assets, is a problem of liquidity. So there is this the continuation of this Office of the Controller of the Currency. The bank management must ensure that sufficient funds are available at a reasonable cost to meet potential demands from both funds providers and borrowers. So we talked about how you can borrow from the LIBOR market for your short-term needs, and then you can actually create some sort of a buffer for yourself that you do not have to incur significant loss if your deposits were called upon, or if you cannot collect your credits on time, and therefore have to incur significant losses to meet your liquidity demand. So, having the cash will obviously give you that buffer. The ability to borrow in the short banking system, money market, LIBOR market, is another buffer for you to meet that liquidity demand. But the bottom line is, as a bank, you have to maintain your liquidity, and the obvious ultimate solution would be to keep all your deposits in-house. However, then you're a bank. What's your purpose of existence? You need to lend that money out. So you have a criteria. On one end, do not lend any of your money. You're 100% liquid, and therefore you have no liquidity problem. And then on the other, you will actually lend out everything, and then all of a sudden you have a liquidity problem, and if you cannot borrow to create that buffer for yourself, then you are having an existential issue. So FDIC is the institution. The Federal Deposit Insurance Corporation is an institution that ensures that the banks meet certain criteria for their liquidity requirements. And these liquidity requirements are dynamic. They change every day and during the day. And the liability or the responsibility of the FDIC is to maintain the entire system from liquidity shocks. And these shocks actually do change based on sometimes non-liquidity issues. So I pulled up this FDIC document that lists the liquidity and funds management, and I provided this link on Canvas. This is actually a significant document. It's pretty short. It's about 24 pages. And you can actually see how they actually look at certain risk measures, some policies, and how the reporting requirements are, and the funding sources for the banks for their liquidity needs. And notice how they actually have sweep accounts, and they have deposit rate restrictions and broker deposits, and so on and so forth. But notice also how they have the borrowings and the federal funds, and central bank is always the lender of last resort. And then we have the Federal Reserve Bank facilities, the lending windows, and then repurchase agreements with the Fed, and so on and so forth. So just as a side note, by the way, now that we're talking about the repurchase agreements, when the banks actually have to keep cash or the reserves, because cash and reserves do not earn any interest, sometimes banks will be allowed to keep cash-like items, and those are the U.S. Treasuries. If the U.S. Treasuries are less than 3 months, they're usually considered to be risk-free, and therefore the banks may be allowed to keep them as their cash-like items within their reserve account. So time to time, instead of selling and liquidating their treasury bills, they might actually get into a repurchase agreement with the Fed and to borrow against their treasury bills. And the repurchase agreement works in a way in which the bank sells these treasuries to Fed with the promise of buying it back. And a reverse repurchase agreement is that the Fed sells the bills to the bank with the agreement of buying them back. So in a way, it is a buy and sell transaction predetermined to give you the access to cash by actually selling and then buying it back your treasuries. That's why it's called repurchase agreements or repo for short. It's significantly more common or popular in outside of the US, especially for retail. But in the US, it's a lot more institutional and usually with banks and the central bank. But so to explain why this system is dynamic, one of the issues that we have is that the liabilities that we have as a bank, the $750,000 that we're going to lend out, as we have people defaulting on their loans, the amount of reserves that I have to set aside changes. If I have more people defaulting on their loans, I may have to set aside 20%. So all of a sudden, what happens is my reserve requirement goes from $150,000 to $200,000, which means what's available to me is $700,000. But again, I already lended it out at $750,000, so therefore now I have a liquidity problem of $50,000. Let me just repeat that. With a 15% requirement, my reserve requirement was $150,000. So thinking that I have $750,000 of available funds, I lend them out. Now, while I lend them out, my credit clients, some of them stop paying mortgage payments and they become default. As they become bad loans, I'm now subjected to a higher reserve requirement. This is after the fact. After I thought that I had $750,000 money available to me, the people became bad debt, and therefore I now need to set aside more reserves. So if I'm subjected to say 20% or even 25%, then all of a sudden now I have to set aside $250,000 reserves, which was originally $150,000. So now I need to come up with an additional $100,000, and that's not an easy task. So again, if you look at, say, for our example, obviously this is just $100,000, but if you look at, say, what it was for JP Morgan Chase, look, their entire asset base, their net loans is about $1.1 trillion. So if you look at their receivables even, you look at it about $200 billion. Now, along these, notice how their total deposits is about $2.3 trillion. So even a slight change in the reserve requirement would actually mean billions of dollars for Chase or for Bank of America or for these national banks. Even for smallest banks, we're talking about hundreds of millions of dollars of reserve requirements affecting your liquidity needs for the long run. And this need is not for overnight. This is not something that you can fix overnight. And therefore, it's not like you could go to the labor market and borrow this money. But you need to actually maintain this excessive amount of reserve requirement going forward, which means that you need to increase the reserves. So sometimes banks will resort to what we call capital raising or capital requirements. It simply means that at this point, the owners of the bank, the shareholders of the bank, or whoever is in charge of maintaining the integrity of bank's equity, needs to come up with the missing funds. And that's where the capital requirements come in. They may be required to put up the difference where the bank is coming short with respect to liquidity. That's a separate video. We're going to talk about the capital requirements. However, if a bank cannot borrow and if a bank cannot actually make the liquidity available at that point, they really have no other choice but to resort to increasing capital from the shareholders or, like I said, whoever's in charge of the bank's equity integrity. So when you look at the, in the case of, say, Chase, if you look at their capitalization, you'll notice $715 billion of total capitalization. And this is actually significant comparing it to about $3.6 trillion of total assets. So for a almost $7 trillion of assets, their capitalization is about $715 billion. So the capitalization allows the bank to actually dip into the requirements of liability and therefore to maintain a larger buffer for the bank, not only their ability to borrow more and therefore provide a better and more reliable and sustainable buffer, but also, if need be, to dip in and to make up the difference with respect to the reserves that they need to actually make. So the FDIC and the Fed regularly actually does checks on banks. They want to make sure that they can actually have contingent funding. Within this scheme of the liquidity, they said not just the cash at hand, but also the maturity mismatch of the deposits and the credits. And if the deposits become due, how does the bank plan on paying these deposits on time? Or if some of the credits needs to be paid early, how does the bank plan on paying these? So the role of equity, the capitalization is well defined by the FDIC and the Fed. And some of the items that we may not see as immediate, they may become immediate, and their reserve requirements is slightly different, but the FDIC kind of puts them all into one reporting scheme. And within that, they actually have what's called a stress test. Now, these stress tests are done frequently, and we do hear them often, especially during the COVID times. I'm sure you heard that the Fed and the FDIC in collaboration did the stress tests for banks. This is to see if certain amount of credits go bad, how much liquidity would be missing for the bank's balance sheet, and therefore how would the bank pay up the difference. And if banks cannot come up with contingent funding or the capital requirements, then that means they fail the stress test. So here I pulled a press release from June 28th of this year, where the Federal Reserve released the results of an annual bank stress test. This is exactly what we just talked about. It is to see if there's a severe recession, the expectation is some of the debt, some of the credits will go bad, and therefore the reserve requirements will be higher, and therefore the banks will need to come up with the liquidity to make up the difference. So this difference from, say, 15% where the available funds is 750, going to, say, 25 or even 30% where you now have a missing $150,000. So where will the bank come up with that money? And that's the purpose of the stress test. The bank's supposed to have contingent funding. It's supposed to have capital requirements or capital integrity, and the Federal Reserve wants to have banks to pass this stress test, along with to have an excess buffer to continue to lend to households and businesses, so that the recession is not exacerbated, and the banks do not cause an excessive amount of ripple effect in the market. Because if one bank has a liquidity problem, then they won't be able to lend anymore. And if they cannot lend anymore, then the economy will come to a standstill, And we might actually have a contagion effect with the other financial institutions having the same issue. So liquidity is a problem of credit and liability and asset management for the banks, and not just cash at hand. It is more about, just as right here, the Office of the Controller explains it, it's the inability to timely meet obligations without costs. And if a bank cannot maintain their stress test, then it is upon the FDIC and the Fed to make sure that the capital adequacy is or has its integrity, and that the banks can actually maintain to function as banks for a healthy economic performance. So in the next video, we'll talk about the assets and then the liabilities and the banking, the capital integrity. So I'm available to meet via Zoom. Please let me know if you have any questions, and thank you for working with me, and I appreciate it.